financial reporting section, because from the financial reporting section, normally the investors will make a decision whether to invest or not in the company, or maybe if the investors is already invested their money in the company, from the financial reporting section, they would make a decision whether to sustain their investment in the company, or to withdraw their investment in the company. So it is very important and very crucial data from as far as the investors, as far as the public is concerned. So from the government point of view, the annual report, especially the financial reporting section, is very important for tax purposes. So it will shows whether the companies will have good governance or not. So normally, as I mentioned last week, some of the company, they have a very prominent figure or prominent person in their board of directors, or in their management team. So it is sort of a strategy by having a prominent person in the company. So it could somehow convince the investors that the company is being managed and headed by a qualified person. So as this is the information that I just said, I said just now, part of the content of the annual report, the corporate structure, including the board of directors, the senior management, the financial disclosure, everything. So it is not available for privately owned entity, as I mentioned just now lah. Most of the privately owned entity like sole proprietorship, partnership, and private limited company, they don't share their annual report or their financial data to the public. So as far as the annual report is concerned, from the business valuation perspective, the type of data that is important for the business valuation valuator is the financial statements. So normally, in order to carrying out the business valuation, the business valuation valuator will need some sort of financial data. So therefore, they will refer to the company's financial statements. So as I mentioned last week, the most common financial statements that could be referred to is a balance sheet and income statement. But sometimes they may also need to refer to the cash flow statement. So from this financial statement, we can then compute the financial ratio analysis in order to look at the company's performance for the past years, or for the current year. So it is crucial for the business valuation valuator to understand, or the business valuation valuator should be able to understand the content of the financial statements. So that's why for that reason, for real estate students at any university in the world, they will study the basic accounting for them to understand what is included, type of data which is included in the financial statements. So the first one is a balance sheet. So balance sheet is also known as statement of financial position. So as it is mentioned in the slide, a balance sheet is a snapshot of what a business owns, or the company's asset, and what the company's or the business owes, which is the company's liabilities, at a specific point in time. So a balance sheet is usually completed at the end of the month, at the end of a month of the financial year and is an indicator of the financial health of the businesses. So by looking at the balance sheet, those who understand about financial, so they would know how is the company's performance. So in other words, is how is the financial health of the company. So normally it could be prepared in the form of a T format or in the form of statement. Normally, if it is if it is prepared in T format, asset will be on the left hand side, liabilities on owner equity will be on the right hand side. So basically, by looking at balance sheet, if we discover that from the balance sheet we discover that the amount of asset is higher than amount of liability and owner equity, it shows that a company is in a good a financial position. Why? Because if something happens, if the company has a financial issues or financial problem, the amount of a company's asset can or sufficient to cover the amount of company's liabilities. So that's why normally what we are expected to see from the balance sheet is amount of asset is higher than amount of liabilities and owner equities. So what will happen if by looking at balance sheet we discover that amount of asset is less than amount of liabilities and owner equity? So if the amount of asset is less than amount of asset, if the amount of asset is less than the amount of liability on owner equity, meaning that the companies are in trouble. So if something happen, the company's asset is not sufficient to cover the company's liabilities and owner equity. So that's why from the accounting perspective, the amount of asset and amount of liabilities and owner equities must be at least equal. So if the amount is equal, that meaning that the company is not doing good or is not in the worst position. So it is at a zero a par. So meaning that if the amount of asset and liabilities is equal, the company's asset just enough to cover the company's liability. So most of the time we are expecting to see that the company's asset is higher than liabilities. So if the asset is higher than the liabilities, meaning that the company is efficient in managing their working capital, in managing their expenses. So the balance sheet give an overview of the company's position. So available for public and private entities. So the balance sheet is suitable to be used if we are about to value a business using asset approach. So if you are using if you are valuing a business using asset approach, this is a type of financial statement that you need to refer to. So remember, so if we are using an asset approach, so we need to refer to the company's balance sheet or statement of financial position. So so it is also used for the identification of shareholders fund or equities. So normally we will need at least 3 years performance or the past 3 years balance sheet in order for us to do the valuation. So we need to sort of do some analysis for the past performance of the company. So last week we have gone through the topic on what is the stages or what is the steps involved in carrying out the business valuation. So one of the stage that involved in business valuations activities is collecting and analyzing data. So we will collect a series of balance sheet. So as I mentioned just now, normally at least for the past 3 years, but in some circumstances or in some situation, if the economic condition is not that good, we may need at least 5 years performance for us to look at and to analyze. So, but in a normal situation, normally we will only need to look at the past 3 years performance. So, in other words, you have to dig out the company's past 3 years annual report. So from the past 3 years annual report, we would be able to get the past 3 years financial statement. So as far as business valuation is concerned, if we are using an asset approach, so we need to refer to the company's balance sheet. So I'm sure that you all already knows how the balance sheet or the statements of financial position looks like. But don't worry, for the purpose of this lecture, we will show you again the format or the balance sheet. So this is how the balance sheet looks like. So in this slide, the balance sheet is prepared in the statement format. So if it is prepared in statement format, so asset will be on the top of the statement, liabilities and owner equity will be on the bottom part. If it is prepared in the T format, so asset will be on the left hand side, liabilities on owner equities will be on the right hand side. So as far as this slide is concerned, the balance sheet is prepared in the statement format. So therefore, we could see that the asset is located or prepared on the top of the statement, and the liabilities is on the bottom part. So this is how the balance sheet will be presented. So for an asset, it will divided into two separate categories. The first category of asset is current asset. So the second one is non-current asset. In some of the textbook, non-current asset, they will put it as fixed asset. Aset bukan semasa or aset tetap. So non-current asset is aset bukan semasa. Fixed asset is aset tetap. Some books, they may not use the words non-current asset, but they will use the words fixed asset. So it is depends lah whether you are referring books from which country. But some of the book, they will use the term non-current asset. Some of the book, they will use fixed asset, asset tetap. So under the current asset, the company will list down any current asset which they own. So the type of current asset, for instance, is cash, account receivable, inventory. Bank account is also categorized under current asset. So what is account receivable? Account receivable, if you refer to some accounting book, they put it as debtors. Account receivable is account diterima. Debtors is your penghutang. So if you refer some of the books, they don't put it as account receivable. They put it as debtors. Debtors is your asset, meaning that the money which is not with you yet. The amount should be yours, but it is still with your debtors. So that's why debtors will be listed under current asset. The next category of asset is non-current asset or fixed asset. So under the non-current or fixed asset, it will be, for instance, plant and equipment, any buildings or business premises, any vehicles that is owned by the company. So if you look at the accounting principles or accounting terminology, anything that can be converted into cash within 1 year or less will be classified under current asset. Anything which is owned by the company which need more than 1 year to be converted into cash, it will be listed under non-current asset or fixed asset. So meaning that if you are looking at a company's asset, if it can easily converted into cash, which will take less than 1 year to be converted into cash, so it will be classified or categorized under current asset. If it needs more than 1 year to be sell or to be converted into cash, so it will be classified under non-current asset or fixed asset. So normally the company will report the amount of current asset and non-current asset that is owned by the company. So in this example, the company has 20,000 cash, 15,000 account receivable or debtors, and 150,000 inventory. So for the non-current asset or fixed asset, the company has 50,000 in the form of plant and equipment, 650,000 in the form of business premises, and 70,000 vehicles. Can you guys see the slide? Yes or no?
Yes.
Yes, sir, yes.
Nanti I shot sendiri, nanti you tak nampak. So for those who really understands about financial statements, from these financial statements, we can tell that the companies is not that good because the company has quite high amount of receivable. So if you understand about financial statement, you can see that the companies is quite weak, or the company is not good in managing their account receivable. 15,000 is quite high. Why I am saying that the company is not good in managing the account receivable? Because this account receivable, if you do not manage to collect the amount by the end of the financial year, it could potentially become bad debt, hutang lapuk. So bad debts, after a certain period of time, if you still fail to collect bad debt, it will be absorbed as part of your expenses. So that's why if you look at the nature of the business out there, most of the company, they have very strict rules and regulation about the credit sales, because they don't want to have high amount of account receivable. So if it is reported in the balance sheet that the company has such a huge amount of account receivable, it means that the company is not good in managing their debtors or account receivable. Maybe the company has a very lenient credit policies. So most of the company, in order to avoid from having a huge amount of account receivable, they will have quite strict credit policies. In other words, that before they give a credit to their buyers, they will scrutinize their buyers' financial information. So if they feel that the buyers are in a good financial position, they will approve the credit facilities for the buyers. If they feel or they think that the buyers is not in a good financial condition, they may reject the buyer's application to for credit transaction. So credit transaction meaning that you take the product first, then you buy later, you pay later. So so as far as this company is concerned, we may say that the company is not very good in managing their account receivable, because we can see that the amount of account receivable is quite high, which is 15,000. So the company may need to revise their credit policies in order to have a lower amount of account receivable in reported in their next balance sheet. So inventory again. So from this balance sheet, we can see that the companies is not good in managing their inventories. Kan? For a companies to have 150,000 amount of inventories reported at the end of the financial year, it is not good. Meaning that the company are very weak in managing their inventories. Normally, companies won't keep too much inventory at one time, because it depends on the business. Let's say if you are running a mini market or hypermarket business. So for mini market and hypermarket business, if you are having 150,000 inventory in your balance sheet, it shows that you are not good in managing inventory, because inventories could be in the form of perishable product. Perishable product ni barang yang mudah rosak. So if you keep too many perishable product in your inventory, so you may not to have a chance to sell it back in the next financial year. So normally the company will keep these two items, account receivable and inventory, as low as possible. So if you are having a high inventory amount, it shows that you are not good in managing your inventory. So let's move to the non-current asset. So this company has only 50,000 worth of plant and equipment, and then 650,000 premise, maybe in the form of offices or shop offices. So 50,000 vehicles. So this is the amount of current asset for the company. This is the amount of non-current asset of fixed asset. So this is the total asset for the company. Total asset means that the amount of non-current asset plus the amount of current asset. So the company has just below 1 million worth of asset. So for a small company, let's say this company is a sole proprietorship. If a sole proprietorship has about 1 million worth of asset, it is quite good lah. So for this company, the total of asset is 955,000. So let's look at the company's liabilities. So account payable, the other names of account payable is creditors, permutang. So this is the amount that we owe to the other parties. Account payable, 25,000. Bank overdraft, 10,000. Credit card, 5,000. tax liability 30,000. So as far as the company is concerned, they have about 70,000 of current liability. Oh, before I forgot, current liability is also same with asset. Liabilities. Liabilities is same with asset. Liabilities will be divided into two categories, which is current liabilities and non-current liabilities. So current liabilities is any debt that you need to pay within 1 year. So any debt that you need to pay over 1 year or more than 1 year, it will be listed under non-current liabilities. So some accounting books, they will put as short-term and long-term liabilities. So current liabilities can also be recorded as short-term liabilities. Non-current liabilities can also be recorded as long-term liabilities. Short-term liabilities meaning that anything that you have to settle, you have to pay within 1 year. So anything that you have to pay more than 1 year, it will be categorized under non-current liabilities or long-term liabilities. So this is the example of current liabilities whereby you need to pay within 1 year. Account payable or your creditors, bank overdraft, credit card and tax liabilities. Why tax liabilities is categorized under current asset? Anybody has any idea? Why tax liabilities is categorized under current liabilities? The answer is because for any taxation that you have to pay within the current years. So meaning that if it is tax for 2020, so you need to pay the tax within 2020. You cannot carry forward to next year. If you carry forward to next year, inland revenue will give you compound for the late payment. So that's why tax liability will be listed under current liabilities, meaning that you have to pay within 1 year. So example of non-current liabilities or long-term liabilities is bank loan. So normally bank loan, if the loan you have to pay within 5, 10, 20 years, so it will be categorized under long-term liabilities. So remember, as I said just now, anything that you have to pay within 1 year or less will be categorized under current liabilities or short-term liabilities. Anything that you have to pay more than 1 year, meaning that the term that you have to pay for the loan is longer, more than 1 year, it will be categorized under non-current liabilities or long-term liabilities. So this is the total liabilities. 500,000 plus 70,000. So you have 570,000 worth of liability as compared to 955,000 worth of asset. So as far as this company is concerned, generally the company is in a good financial position. Why? Because the amount of asset is almost double to the amount of liabilities. So meaning that if the company is about to go bankrupt, the company has sufficient asset to cover the liabilities. So far, any question before we move to the next slide? No question, right? Okay. So this is some notes or explanation about the current, non-current asset, current and non-current liabilities. So we may put here current asset is also known as fixed assets. Current liability sometimes is also known as short-term liabilities, not term. And non-current liabilities is also known as long-term liabilities. So for current asset, it remains as current asset lah. So current asset is anything that you need to that can be converted into cash within 12 months. So this is more than 12 months. So this one I've already explained before. So we don't need to spend much time on this slide. So that's all about balance sheet. Balance sheet is also known of, just put it here, statement of financial position. So this is the other names of the balance sheet, statement of financial position. So if you refer some books, they put it as statement of financial position. Even in some of the companies' financial statement, they don't put it the heading as balance sheet. They put it as statement of financial position. So if it is put under statement of financial position, that means that it is the company's balance sheet. So now let's move to income statement. So if the balance sheet or statement of financial position give us some indication on the company's asset and the liabilities, income statement generally give us some overview on the company's profitability, the company's revenues and expenses. So from the income statement, we can see how much profit that the company makes during the financial year, how much money that the company has spent in order to generate profit during that financial year. So this income statement will tell us some indication whether the company is good in managing their expenses, whether the company is good in using the asset that the company has to generate income, to generate profit. So that's why if you look at the topic, the financial ratio topic, some of the topic will be ROI, return on investment, return on asset, return on equity. So for return on investment, return on asset, return on equity, we can measure for every single ringgit, every single dollar, every single pound that the company has, how much profit, how much investment that the company could generate. So basically from this income statement, we would know lah whether the company is efficient or not in maximizing profit using the asset that they have in operation. So overview, the income statement is an overview of the company's profitability of the current year. Again, for any of the financial statement, it will be prepared according to the financial year. So that's why if you look at the financial statement, normally on the top of the balance sheet, on the top of income statement, it will have some heading. Let's say balance sheet for A to Z Limited as at 31st December 2019. Normally, the headline of the income statement, they will include the date. The date normally would be the date of the financial year. So if it is stated as at 31st December 2019, meaning that the company's end of financial year is 31st December 2019. So normally it will stated the date on the top of the financial statement. So available for public and private entities, suitable for income approach. For balance sheet, it is suitable for asset approach. For income statement, if you are doing business valuation using income approach, so this is type of financial statement that you may need to refer to. So remember, balance sheet for asset approach, income statement for income approach. So by using income approach, we will look at the EBITDA, the price earning multiple, the capitalization, discounted cash flow, etc., etc. So EBITDA is earning before interest, tax, depreciation, and amortization. So EBITDA. So if you are study about investments, so you will come cross lah the term EBITDA, EBIT, ROI, ROE, ROA. So you have to recall back lah your knowledge or your memory on those terminology on those concept, EBIT, EBITDA, blah 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 blah. So again, in normal situation, normally we will have to look at the past 3 years income statement, but sometimes we may need to look at more than 3 years. It depends on the time, the economic situation. Where do you do the business valuation? So if the economic situation is stable, so you may need only 3 years performance to look at. If it is not stable, maybe you need to look at longer period. So the 3 years ni is the minimum. There is no minimum, there is no maximum, but minimum 3 years. Usually produce monthly. This is a summary of income and expenses for the business, known as profit and a loss, which will inform you whether your business made money or lost money for the month under review. So normally the income statement will be prepared on monthly basis, but at the end of the financial year, they will report the income statement for the whole year, the whole financial year. So when you study accounting, you have studied this under profit and loss account. So remember, previously we start with the trading account before we do the profit and loss account. Trading account normally will be used in order to calculate the general, the gross profit, and the profit and loss account is normally to calculate the net profit. So a combination of trading and profit and loss account will form an income statement. So the first part of the income statement will be trading account, whereby we will calculate the gross profit, and then after that we will move to the profit and the loss account, whereby we calculate the net profit for the company. So you may need to recall back lah the format of trading account, profit and loss account. So in order for you to understand what is income statement is all about. So you need to know lah the basic step, the process and procedure on how we calculate the profit for the company. So normally income statement have 5 components. So the first component is the revenue. So revenue will be in the form of sales or turnover. So the second components will be the cost of goods sold. The next component will be gross profit. The fourth component will be expenses incurred in the business. Then the last component will be net profit. So if it is a profit lah, if it is a loss, it will be net loss. So this is the type of information, the components that we may find from the income statement. So this is how income statement looks like. So this is, as I mentioned just now lah, income statement for the years ending 31st December 2017, meaning that for this company, the company has been established on the 1st of January. So the end of financial year will be 31st December every next coming years. So as far as this income statement is concerned, any amount which is stated in this statement is only true and correct until this date. When you enter the new date, this amount may not be correct anymore. So this is the amount as at 31st December 2017. The revenues. So the sales revenues for the companies is 500,000. They don't have any other revenue. So they don't have any sales return or allowance. So the total revenues for the company is 500,000 or 500,000. So now from the total revenues, in order to get a gross profit, they have to deduct the cost of goods sold. So in this example, the cost of goods sold is 150,000. So the gross profit for this company is 350,000. How do we get cost of goods sold? So this is why I said you need to recall back lah your accounting knowledge, what you have learned during your accounting subject, how to calculate, how do we get the cost of goods sold. So it is very important, because from the total revenues, we have to take out the cost of goods sold before we can get the gross profit. So from the gross profit, we will then deduct or take out any expenses which is incurred in the business during the financial year before we can get the net income. So look at the expenses. Advertising, accounting, bad debts. So in this example, the companies did not manage to collect 1,000 of their debtors or from their account receivable. So therefore, it will be converted into bad debt. Bad debt will be considered as the company's expenses. That's why just now when we look at the balance sheet, I already explained that normally we don't want to see how amount of account receivable or debtors reported in your balance sheet, because high amount of account receivable or debtors could potentially become bad debts. So if that is so bad debt is considered as your expenses. So depreciation, 50,000. So this could be depreciation of your asset, which will be considered as your expenses. Employee payroll tax. So this is the employees tax that employees tax that you need to pay to the government, 15,000. Employee wages. So this is your salary for your employees. Insurance. So insurance could be building insurance for your premise, or could be your fire insurance for your premise. Interest expense. So it could be any interest that you have to pay to the bank for your loan. For any of the company's loan, it will be charged interest. So interest is considered part of your expenses. Miscellaneous is other expenses, rent. So maybe you rent the office or the shop, software, telephone, utilities. Utilities normally including electricity and water bills. Web hosting. So maybe the company has a web hosting to for the company's website. Vehicle expenses. It could be any fuel, petrol, diesel for the company's vehicle. So this is the total expenses that the company has spent during the financial year. So 258,500. So this amount will be taking out from the 350,000 gross profit. So only leave us about 91,500 ringgit net profit. So this is net profit before tax. So from this amount, government will charge you based on a certain percentage lah for your tax. So this is the amount of your net income or net profit before tax. So if you don't have to pay for the tax, so the amount remain as your net profit lah, net income. But if you have to pay for the tax, so it will be lesser after you have to pay for the tax. So basically, this is quite a simple example of income statement. Some of the company you may find their income statement is more complicated, which involve more type of expenses, more type of revenues. So, but as far as this example is concerned, it is quite a simple example. So this is the brief explanation about income statement. The net profit will show whether the business has earned or lost money. So normally if it is net profit, the company has earned lah. But if it is net loss, meaning that the company has lost money. So gross profit is an indicator of efficiency. The higher the gross profit margin, the better, as the business keep more each dollar of sales. If a gross profit margin decrease over time, it will need to determine the reason and take action to address the decline. So normally, the first step in measuring your profit is a gross profit. So normally basically the gross profit is an indicator whether your company is efficient or not in running the business. If the amount of gross profit is high, meaning that your company is efficient. But if the amount of gross profit is low, meaning that your company is not efficient in generating income. So the net profit margin is indicator how much profit it makes from every dollar spent. A fall in net profit margin generally means the company are paying more expenses, which need to be monitored. More profitable businesses generally spend less of their income on expenses. So in order for the company to generate a higher profit margin, they need to increase their gross profit and at the same time decrease or reduce their expenses. So high income, high revenue with a low expenses will produce high profit margin. Some company, they produce more high revenue, but at the same time they spend more money for expenses. So therefore their profit margin is low. So in order for us to generate high profit margin, we need to increase your gross profit and decrease your expenses. So that's all about income statement. So now let's move on cash flow statement. Before we move to cash flow statement, do you have any questions on income statement? So we have gone through the balance sheet and income statement. So now we move to cash flow statement. So this is the slide on the cash flow statement. So cash flow statement is an overview of the company's cash flow for the current year. Again, it is available for public and private entities. We may need at least 3 years of the cash flow statement for the business valuation purposes, but it depends. If the company is not stable, so we may need more than 3 years. So the cash flow statement interpret the three types of cash flows in the following ways. So from the cash flow statement, we could get info or data on these three types of activities. So operating activities, investing activities, and financing activities. So basically, the cash flow will give us some indication on these three types of activities. So in other words, by looking at the company's cash flow statement, we may know about these three types of activities of the company. So what is operating activities? Operating activities is the cash flow statement converts the entries in the income statement into cash actually received and paid. So for the operating activity, we may see from the cash flow statement that the money comes in and the money goes out. So meaning that we may or we could monitor amount of receivable and expenses from cash flow statement, because in the cash flow statement we will record every single penny, every single cent that we receive, and every single cent that we spend. So that's what it means. By looking at the cash flow statement, we may know about the operating activities. So the next types of activities that we may get or know or get from the cash flow statement is investing activities. So the cash flow statement give details of the fund invested either in land or machinery. So every single investment activities will be recorded in a cash flow statement. So any single cent, any money that you spend for investment activities will be recorded. So the next activities that could be found from the cash flow statement is financing activities. So the financing activities is about the cash flow statement, which provides information about issuance of the company's own stock and bonds as cash transaction. So this is the example of cash flow statement. So, guys, before I forgot, Dr. Zai just informed me this morning that the assignment task or assignment question will be given to you on Wednesday during your lecture slot on Wednesday morning. So I will give you the task or the assignment questions on Wednesday morning. So because she's now in the final stage of preparing the task for you guys for your assignment. So we will go through the questions on Wednesday morning. So this is how the financial statements, the cash flow statement looks like. So it will list the cash inflows out or outflow. So cash flow from operating activities, cash received from customers, cash paid to the suppliers and employees. So cash generated from operation. Cash generated from operation is the differences between cash received and cash spent. Dividend received, interest received, interest paid, tax paid. So normally in accounting, when the amount is put in bracket, meaning that that is the amount that you spend, the amount that goes out from the account. So any amount which is put in bracket, meaning that you spend the amount. You have to minus, you have to deduct the amount. So the next type is cash flow from investing activities. So addition to equipment, so they spend 2,500 to buy new equipment. They spend 7,000 to replace some of the equipment. Then they receive proceeds from sales of equipment. So from these activities, we spend 9,500, but we only receive 500. So we still have a minus 9,000 from the investing activities. Meaning that from investing activity, we lost 9,000, but from operating activities, we made 24,800 ringgit. So from cash flow from financing activities, so profits from capital contributed 3,400, proceeds from loan 16,000, payment of loan 5. So we made 13,000 ringgit. So net increase or decrease in cash. So net increase or decrease, we total up the amount. So where do we get 28,800 from? Where do we get 24,800? Taking out 9,000 plus 13,000. So we will get 28,800. So this is the comparison between income statement, balance sheet, and cash flow. In terms of time, so income statement is period of time, a point of time, a point in time, period of time. The purpose income statement is to calculate or to look at the profitability. The balance sheet is for us to look at the financial position. The cash flow is to look at the cash movement in the company. So measure, the variable is to measure. Income statement is to measure revenues, expenses, and profitability. Balance sheet is used to measure asset, liabilities, and shareholders' equity. So whereas the cash flow is to measure any increases or decreases in cash. So in other words, that from income statement, you may have data or information on this. From balance sheet, you may have data on this, and from cash flow, you may have data or information on either your cash has increased or decreased. So starting point, revenue, cash balance, net income, ending point, net income, retained earnings. So this is not important. So we have look at the three types of financial statements for a businesses. So from this financial statement, in order for us to do the business valuation, we need to do some sort of analysis. Remember, because the statements is only give us financial data, financial information. So we need to translate the information in a meaningful way. So therefore, we need to compute or carry out the ratio analysis for every information that we may get from the financial statement. So there might be a certain types of ratio analysis that we may need to do based on the types of financial statement that we refer to. So let's say, for instance, there are certain types of financial ratio analysis that we may perform or compute from the data that we get from balance sheet. So there are certain types of ratio analysis that we may perform or compute from data that we get from income statement, and then there are also certain type of analysis or ratio that we may compute from data that we get from cash flow statement. So the type of ratio analysis that you may need to perform or compute is depends on the type of valuation, the type of method or approach that you use in carrying out your business valuation. So what is a ratio analysis? A ratio analysis is a mathematical expression relating one number to another, often providing a relative comparison. So as with all types of fundamental analysis, it is often most useful to compare the financial ratios of a firm to those of another company. So basically, ratio analysis is a mathematical expression. So meaning that we compare one number to another in order to get relative comparison. So normally we will compare the result of ratio analysis either between the company's own data or between the company's data with their competitors' data. So we will go through some example on how to compute or to calculate, to perform the ratio analysis. So if let's say from the analysis we get a figure 5, so what does the number 5 means to the company as far as the ratio analysis is concerned? I have headache this morning, so I cannot concentrate on the lecture. So So over the years, investors and analysts have developed numerous analytical tools, concepts, and techniques to compare the relative strengths and weaknesses of the companies. These tools, concepts, and techniques form the basis of fundamental analysis. So as far as this financial statement is concerned, we will compute the financial ratio analysis in order to get some relative comparison on how does the companies perform before we can derive to a value for the companies for our business valuation purposes. So therefore for business valuation purposes, it is crucial for us to do the ratio analysis. But as I mentioned earlier, before you can do or before you can compute the ratio analysis, you have to make sure that you understand or you know how to go about with the data that you may get from your financial statements. So as far as business relation is concerned, if you are valuing the business using asset approach, so you need to refer to balance sheet. If you are using income approach, you may need to refer to income statement. So ratio analysis is a tool that was developed to perform quantitative analysis on numbers found on financial statements. Ratios help link the three financial statements together and offer figures that are comparable between companies and across industries and sectors. Ratio analysis is one of the most widely used fundamental analysis techniques. So in a business world, not only a business relation, ratio analysis is very crucial, very important to give indications or indicators to the stakeholders on the business performance. So it can be compared using the company's own data or between the companies and their competitors within the same industries. So if we are about to compare the company's performance with their competitors in the industries, so we need to gather data of a company within the same industries. So now we move to the type of ratio that we can compute or do for these purposes. So the first type of ratios that we may compute is activity ratio. So we have gone through this topic, activity ratio, when we do our financial management topic while you were in your first semester in your accounting and financial management subject. So activities ratio normally measure how efficient a company utilize its asset. So in order for you guys to compute or to calculate or to know the activity ratios, we need to refer to the financial statement. So you need to identify which financial statement that you may need to refer to in order to compute the activity ratios for the company. So there are few categories or few types of activity ratios that we may perform for the company. So this is the types of activities ratio that we may perform. So we may compute the account receivable turnover. So with account receivables turnover, this ratio can be calculated by dividing credit sales by account receivable. So where do we get our amount of credit sales and account receivable from? Anybody has any idea? From which financial statement that we may find the amount of our credit sales and account receivable?
Balance sheet.
Balance sheet? Are you sure? So,
Yes.
macam tak confident je.
Balance sheet.
Balance sheet. Balance sheet.
So we may get the info from our statement of financial position or balance sheet. So by looking at the amount of credit sales divided by the amount of account receivable, we may know our account receivables turnover. So this is the formula. Credit sales divided by account receivable. So this is a simple example. Sales, data for sales we get from your income statement, your total sales. So for account receivable, we get the amount or the data from balance sheet. So from this example, the amount of sales is 800, and then amount of account receivable is 200. So the account receivable turnover is 4 times. So for account receivable, it means that the company has a higher potential of converting sales to cash. So normally the higher the number that you get here is the better. So this one is very simple example. So we just take a sales 800 ringgit, account receivable is 200 ringgit. So the amount of your account receivable turnover is 4 times. So meaning that your sales is 4 times higher than your account receivable. So meaning that the company has a better potential in converting sales into cash. So let's say when you put the amount in the formula, you get 10 times. So meaning that the company has even higher potential. But if the amount or the number that you get here is 1 or 0.5, meaning that the company has a slightly lower potential in converting sales into cash. Guys, I think I have to stop here. I have a really bad headache. I cannot proceed with today's lecture. I will post some tutorial question later today for you guys to go through, and then we will continue our the rest of our slides. We have about altogether we have 37 slides. We just done slide number 16, so we have about 31 to go. So we will continue on Monday morning, but on Wednesday morning. But on Wednesday morning, we will start with giving you the task or question for your assignment. So in the meantime, I will upload your tutorial question before midnight today. So I need to go to the clinic first. If you have any questions, you may ask in our WhatsApp group. So those who have not yet signed in for your attendance in Spectrum, please do so before 1 o'clock, because I have set the time for you to sign in for your attendance between 10:45 until 1 o'clock today. So you have to sign in for your attendance before 1 o'clock. After 1 o'clock, you are not allowed to sign in for your attendance in Spectrum. So it's already 12:30, so we have half an hour to go. I will upload the tutorial questions before midnight tonight, so you may go through the questions, and if you have any questions to discuss about the tutorial question, we may do on Monday on Wednesday. Maybe Wednesday we will spend the first 1 hour to finish off the lectures today, and then the next 1 hour to go through our assignments, questions, and tutorial questions if you have something to ask during the time. So I think we may need we need to dismiss now, because I need to go to the clinic, because I have another class with first year 2 to 4 today.
Yes, sir.
So if you